Nancy. Well, next we'll have Nancy Whaley here with the farm economics panel, and she'll do her introduction of the presenter. Thank you, Nancy.
All right. Thank you. Hi. Good afternoon. It's been a great program so far, and I hope everyone has been enjoying it. And I think the next hour will be no exception. So I hope everybody can stay tuned with us for the full hour because it is full and packed. My name is Nancy Whaley. I'm a Chapter 12 and 13 trustee in the Northern District of Georgia. I do want to let everybody know if you see me disappear at the end of the hour, Brad is going to take over for me. I have a flight to catch, so I may pop out before we finish up, but it's been a great program today. As Courtney said, she'll put the materials in the chat and email them. Also, we'll be monitoring the chat again for questions, so please feel free. And as the topic comes along, we will address those questions. I also want to apologize in advance if my voice starts to waver. Like everybody else, I am fighting this crud that's going around. But with that, I want to introduce Dr. Adam Rabinowitz. He is an associate professor and extension economist in the Department of Agricultural Economics and Royal Sociology at Auburn University and the Alabama Cooperative Extension System. He holds a PhD in agriculture and resource economics from the University of Connecticut. His research and extension program focuses on risk management issues through the interface of agricultural policy, farm management, and marketing. He has contributed to knowledge through the scholarly output and educational programs related to the Farm Bill, economics and production, emerging markets, and farm financials. He's also a previous recipient of the Southern Agricultural Economics Association Emerging Scholar Award. When not working, Dr. Rabinowitz enjoys time with his wife and his two children, residing in Auburn, Alabama. So today we're going to cover kind of three general topics, which are farm economy, agricultural lending and policy, and then the professor's research on Chapter 12. So with that, Professor, there have been news reports about increasing farm income. And as you know, everyone has known that for the past month or two, a lot of these issues have been hot topics in the news. So can you talk a little bit about where we are with the farm economy and what is driving the increase in income, and are all farmers able to benefit from that?
Absolutely. Thank you, Nancy. I appreciate the opportunity to be here with you today. And I was honestly going to give you a little bit of background of myself, but you did a fabulous job. There's just my family as well. Just in terms of my background, I have gotten around the U.S. a little bit, but I am here now at Auburn as part of the land grant institution and focused on, like you said, extension and research in production issues, ag policy, and such. And so I just, talking about the farm economy is something in terms of educating public and policymakers and professionals such as this group is something that I certainly enjoy doing and sharing my research. And so your question about the ag economy, I think is really spot on. We're hearing a lot about farm income and in particular, what the USDA reported as a rising farm income. And you can see that in this graph here up on the right-hand side. It's, we're seeing this large increase from 2024, but I have to say, yes, we've seen lower farm income based on these reports. 2022 was the peak here, but this increase is a little bit of there's some strange areas here that I think we need to talk about. It's not across the board, and it is something that we're going to have challenges within agriculture. And I think you start to see that when you look at these cash receipts. When you look at cash receipts, the actual income that's coming in from selling crops and commodities, all commodities is down in that top line there. But in particular here, you see the animal and animal products, is up a little bit. It's really your crops that are down. And so, when I look at these graphs side by side and I think about this idea, well, farm income's up, but cash receipts overall is down, it really starts to bring some questions in terms of, what's actually happening and what's behind those numbers. And so that's what I want to dig into a little bit further here, because if we just go with the narrative that net cash farm income is higher and expected to be higher in 2025, it's really going to paint a very different picture for different producers and not the full ag economy as we see it. So let's dig a little bit deeper in terms of some of the crop specifics. And as I mentioned before on that previous slide, we saw that those cash receipts, what they're getting for selling on crops is actually looking down. But then we look at crop specific income and we see cotton change from 2025 to from 2024 to 25 as being 28% higher in terms of that net farm income. Wheat 59% higher. And a lot of this is, on the cotton side, there's some of it that's coming from losses to disaster that happened in 24. So there'll be a little bit of an increased quantity that's expected in 25. But the reality is prices are still pretty low. And the previous speaker actually showed some of that, where we've got the kind of low prices, and cotton is not something that producers are breaking even on. And I'm going to talk about government payments in a moment here, because government payments are really what's supporting this net cash farm income that we're talking about. And when we look at this, just if we look at it 2023 compared to 2024, it was significantly negative. Very much total opposite. Cotton down 26%, even corn down 33%, wheat down 42%. And really the negative decrease in terms of farm income in 2024 from the prior year was from continued input prices that maintained high, and prices just bottomed out and really went to very low levels. And that put a lot of stress on our farm economy, and really kind of triggered some government response that happened back in December that really changes the narrative in terms of farm income. But we have to look at this in terms of what happened last year when that government assistance didn't actually come, and now what we're seeing with that government assistance. Like I said, we also have to think about crop specific though, because livestock sector is really those higher prices that are driving that income. Generally lower feed costs. So when you talk about corn prices being low, on the one hand, you've got your corn producers who are saying, this is not a good thing, but you've got your cattle producers who are saying, well, that makes for cheaper inputs. So lower feed costs. And so, that certainly is driving some of this increase in net farm income for our livestock producers, whether that be for dairy or our cattle, even hogs. And so, it's very different in terms of different sectors. Just again, as I mentioned before, in terms of those cash receipts, we can break this down and look at this a little bit over time. And on the left-hand side here, you see those cash receipts that are just, top line being 2023, moving down year to year, and corn, soybeans, your major row crops, wheat, and even cotton a little bit up there because of this, the supply side of things. But it really is those lower prices year after year that are driving those lower cash receipts. The other side on the crops is your fruit and vegetables, and that's where we've seen a little bit of an increase each year, and that's more of that quantity effect taking hold. We're seeing additional demand for those fruits and vegetables, and even export opportunities. On the livestock side, really again, a strong economy for livestock producers. You see the increase overall from 2023 that's happening in terms of the cattle side, the dairy side, broilers, even hogs. We see this continue to increase, and eggs. Well, eggs are are kind of a different game there. There's different things happening, and what happens in terms of even pass through when we see the egg prices in the grocery store versus what actually farmers receive for the eggs. Those actually become two very different things. But really, those cattle sales are just going to be continued, in particular, going to be continued to be higher because of just reduced a supply that's out there, tighter market. So price effect is actually taking hold there to increase those cash receipts. We can break this down from a regional perspective as well. And you see across the board there, again, with this net farm income, not looking at just the cash receipts, but including those government payments that I'm about to get to here on my next slide. Those cash receipts are going to be higher, or no, sorry, the farm income is going to be higher throughout the U.S. And you can see certain areas there within the eastern uplands where we do have, some cotton production, as along with the southern seaboard down in here, this cotton and peanut production in the Texas area here as well. A big support there in terms of some of those government payments that are really driving this net cash farm income. A little bit less and smaller in terms of in the heartland and the northern Great Plains. But overall, we are seeing what this forecast is across the board for that higher net farm income throughout all regions. So let's get into those government payments, because I think it's really important that we put in perspective what that farm income is and how that differs between when we look at those cash receipts being down, but farm income being up, what's been happening in terms of government payments. In particular, if we go back to 2017, and I didn't quite go back that far in these charts here, but if we go back to 2017, there was ad hoc assistance, so just government appropriations that were not part of the Farm Bill, that were just emergency relief. In particular, the Wildfire Hurricane Indemnity Program was introduced for 2017 losses from disasters. And what we saw was from that point on, every year there was additional disaster relief, and then all of a sudden we get to the point here in 2019, I kind of added down here. We'll get to that in a little bit, but some trade issues. But 2020 in particular was, by far a huge peak and a very much outlier in terms of what government assistance would be. And that was related to, large pandemic assistance here, whether it be USDA pandemic assistance or non-USDA being from, the Paycheck Protection Program for laborers, but the other side, the USDA, actually spanning across crops that went well beyond where typical government assistance would go in terms of commodities that were covered. There were poultry producers that received government assistance. There were specialty crop, fruit and vegetable producers that received USDA government assistance from the pandemic. Very different than what is typical from your payments as a function of the crop prices. These are your Farm Bill payments. That and your conservation payments. You can see those conservation payments, while going up in the more recent years a little bit, are pretty steady down there. And the payments that are a function of crop prices, well, when those crop prices are low, those payments are supposed to go up. But what we just talked about was lower crop prices, but these payments not really increasing. And as a result is why we end up seeing this large spike here in 2025 for additional payments that were related to, in particular, the disaster relief as part of the continuing resolution for the budget, the American Relief Act of 2025 in late December. $10 billion that is going to row crop producers, another $21 billion going to producers who had losses in 2023 and 24 from natural disasters. And so you saw that decrease in net farm income in 23 and 24, and you saw relatively low levels of government payments. Now we see an increase in that farm income in 2025, and that's coming really as a result of this additional, this large spike here in government payments. The other one that I did want to mention as well, and just kind of keeping on folks' radar, is 2019. If we go back to 2019, it's important because we start thinking about the first trade war that happened under the first Trump administration. And, this was the market facilitation program. And, so that was, again, ad hoc assistance, additional assistance that went to in particular, soybean producers, cotton producers, a lot of your row crop producers that were, harmed from some of the trade issues.
So, Professor, you just mentioned the economic assistance that was given to for row crop producers. Was that assistance based upon low prices, similar to some of the other previous Farm Bill programs, or is it related to other reasons?
Yeah, Nancy, that's, there are a lot of different reasons that went into that actually. And the way the current Farm Bill is written really focuses mainly on price fluctuations. And what we saw was while prices went down, they didn't trigger any of those Farm Bill payments. Plus, there is a delay in terms of when those occur. And we've seen input prices stay relatively high. And so as a result, margins were squeezed. And so really focused more on that lost revenue. So, the net revenue. So the combination of what was the expected revenue from the price and expected quantity that would be, or previous quantity over the last 10 years that was produced, compared to what the expected revenue is going to be, and what those expected costs were nationally. And so let's just kind of dig into what those costs look like now moving forward, because on the right-hand side, you see here farm production costs, not necessarily at their peak as they were in around 2012 or so. They certainly come down a little bit. We saw a significant increase here in terms of, so that inflation adjusted from a non-inflation adjustment, right? We see just that continued increase in the peak here in about 2022. And so we see it coming down a little bit from there. And that's what, we're showing here, feed prices in particular. As I mentioned before, small decreases in fertilizer costs, decreases in pesticides, but these are still relatively high. Operating costs for 2025 in row crops are expected only to drop very slightly, 1 to 3%. If even that. Cotton is expected to still be up just a little bit, that 0.4%. So we continue to see these higher input costs. And so it was a combination of lower revenues, lower prices, and these higher input costs that squeeze those margins. And so this was a government payment that was based on those margins. Just to kind of put in perspective a little too, with respect to those higher input costs, as I mentioned, we're down a little bit from some of that peak, but even if you look at where on some of the row crops in particular, the change in input costs from 2019 to 2025, we're still talking about 25, 30, in some cases, a lot, 50% higher for some crops in terms of what will be spent or what is expected to be spent in 2025. For certain inputs compared to what was spent in 2019. And, of course, interest is a big one because we have seen interest rates start to go up. But, overall, these higher input costs, while down a little bit, as I showed you on the previous graph, are higher than where they were just 5 years ago. So where we're going and where we've been, like I said, interest rates is one where, we are now up to, we've come back down again, right? Interest rates have dropped a little. This is the federal funds rate. So this isn't exactly the rate that farmers face, but I like to look at this as a baseline because I'll show you in a minute here, it kind of tracks pretty well. But the federal funds rate down just a little bit, at the point where it was back in about 2007 or so, 2008. But certainly, as we start talking about farm financial crisis of the 1980s, right, we're nowhere near where the interest rates were back at that time. So a little bit of a different situation, even though interest rates are a significant source right now of, that farm expense. And like I said, I kind of like to look at this federal funds rate because, if you look at here from 2000 to 2025, just in terms of the average interest rate for different types of ag operations, it pretty much tracks pretty nicely in terms of the, the direction that's occurring with, the actual farm rate being anywhere from 2 to maybe 4% higher than what that federal funds rate is. And so, you could certainly see where farmers right now, again, this is kind of average across the board, regardless of the type of loan they're looking for, paying kind of in that 7, 8.5% range is what's being looked at here for 2025. Of course, a lot of this was driven by inflation, and so we've certainly seen that on the consumer side. With these high inflation rates in 2022, and we've come back down from there, not back to the point where the Federal Reserve would like, and so we continue to which is down more in this kind of 2 to 3% range. I think we're going to end up seeing these high interest rates, pretty much persist, throughout this year. Could we see a cut this year? It's possible. I think it was more likely a couple of months ago, and now it's, inflation is still a little bit more of an issue than what the Federal Reserve would like. So it's likely we're still going to see those high interest rates. Again, though, if we think about where inflation was back in the 1980s and those really super high interest rates, right? Very, very different situation. And so, I think that's one area where there are some differences to the previous farm financial crisis that existed, back in the 80s. So we can look at farm assets and debt, though, as well, and kind of track here what's happening in particular with real estate, because, those interest rates and land, certainly are a big factor. And we see those, land values have just continued to increase over the years. And, the last few years has not changed in that respect. But the debt side of it as well. The non-real estate debt, somewhat flat here, right? Not a lot of movement, but the total debt has been increasing, and that really is from an increase in that real estate. And so, that is certainly one area that could be a concern, is that farms are looking at, taking on more of that land debt, and potentially using, the assets and the land that they have to borrow for operating expenses. And, in situations like that, that can be, a little bit more challenging and troublesome, because, ultimately that was one issue that can get farms in trouble, is ultimately then having to sell land to cover some of those financial obligations, if prices may continue to be low, and if input costs are maintained at these higher levels. So, we could kind of look at it from a financial ratios perspective as well, a debt to asset or debt to equity ratio. And again, that we're not quite down to the, where we were in around 2007 or so, or even again in 2012 in terms of the lowest debt to asset ratio. Certainly lower numbers are better, but equally we're not quite in terms of, leveraged as we were back in the 1980s, with a lot more of that debt relative to, what the assets were. So while we've seen this increase, while that land debt has increased, and land asset values have increased, we have started to see that pull back. Now, what are some of the expectations for land values moving forward? This is on the right-hand side, this is a survey coming out of, Farmer Mac, and it's an agricultural lender survey from the summer of last year. And, largely expectations were, no change pretty much, across the US. Um, Increases very, very small, more in the South and West. But most felt that there was really going to be no change in terms of land values. So it is possible that we could see a little bit of pullback in terms of those increases, um, that we've seen in terms of land values over the past few years.
So, Professor, I've seen this in some of my Chapter 12s, with the higher interest rates, even while the farmers may have some equity that you just talked about, and they really can't tap into it because of the higher interest rates, and then also trying to restructure a plan and maybe trying to do a cram down um, with the higher interest rates become a little difficulty. So with that in consideration and the continued increases in debt, can you talk a little bit about what the agricultural lending landscape looks like and maybe where it's headed?
Sure. When we start thinking about agricultural lending, some of it is breaking down a little bit between two different types of debt that does exist, whether it be the real estate or the non-real estate, and in particular, some of those operating expenses. And, we see here on the left-hand side that outstanding debt, in particular with our commercial banks. This is a growth chart, so change from the previous year. And, we saw that non-real estate debt in particular spike pretty hard there in 2024. And that speaks to, in particular, that those operating expenses, as well as on the cattle side, some of the feeder livestock. But in particular, the operating expenses that, farmers need more of that, those lines of credit. And that is a bit, a challenge. We see this real estate debt coming down, less growth, still growth in that. So still continued, but not as much as where it was back in, just a couple of years prior, in terms of much higher growth in terms of that real estate. So that again speaks to, other lending, other borrowing that's occurring, for farmers beyond just for land. On the right-hand side, we kind of look at some of the volume, and in particular, like I mentioned, it's the operating expenses, it's the feeder livestock, which is where farms are really looking at, adding to their debt portfolio, and not so much in terms of the farm machinery and equipment. And so, there's not a lot of new equipment that's being purchased. That's one reason why we've certainly seen John Deere and others start to pull back in terms of manufacturing and layoffs, with their firms, and so this is a concern, to me, is just the amount that's going into operating expenses, in terms of that debt, and what's going to happen next. Are farmers going to be able to, with prices, in particular on the crop side, with prices that stay low, are they going to be able to pay back that operating expense debt? And that's where these government payments that are, they haven't been distributed yet. They were authorized back in late December. They are expected to be distributed within 90 days, or the legislation says within 90 days. The new USDA secretary was just confirmed earlier today, and that is one of her stated priorities, is to get those payments out into the hands of those row crop producers. But larger operating loans, what are the reasons behind that? And, this is a survey that comes out of Purdue University, of producers throughout the country. And, you can see this. This is, so every January for the last 6 years here. And this in particular right here, this line, that unpaid operating debt is a reason for a larger operating loan this year. And so that is, one area where, we haven't quite seen that large since 2020, 2021. And so certainly some of the pandemic effects that were there and some of those government payments that ultimately came to producers to help cover some of those losses as a result of those pandemic, right? We're starting to get into that reasoning behind those larger operating loans this year. Not so much the input costs, not so much relatively speaking, the increase in operation size or expansion. It is a lot more of that unpaid operating debt, that could be a concern in terms of how long that ultimately is going to last if these prices are maintained at these lower levels. So, another area that we can look at in terms of lending and just kind of health of the farm economy is looking at delinquency rates. This goes back to the third quarter of 2024, and delinquency rates for ag loans. This is based on concentration of lenders. So, those that are making smaller agricultural loans or smaller lenders, not as much of their portfolio. That's where we're seeing that increase. So your really big agricultural lenders, they really haven't seen in the last few years an increase in delinquencies, but we're seeing a bit of an uptick from those that use maybe more of your non-traditional lenders. And so that certainly is something that could start to trickle down into the bankruptcy side of things as farms start continue to experience some additional financial stress.
Professor, would in
Yeah.
those the non-traditional lending institutions you were speaking about, would that include like community banks?
Yes, that absolutely can include community banks there. Yeah. And so going back to kind of the lender's perspective from last summer on profitability, throughout the U.S., you see 2025, the share of ag borrowers that will be profitable through 2025, really doesn't matter where you are in the country. It has dropped quite a bit from where it was 3-4 years ago. In terms of where lenders are expecting profitability in agriculture. But you can again break that down a little bit by sector. And so, what that portfolio looks like, your highest concern is these darker colors on the right, and it's really those grains and the cotton. I would say dairy is always a concern. We've always seen that over the years, but in particular, grains and cotton are your bigger concern, where there's a lot more issue in terms of those that have that in their portfolio. So, that this speaks a little bit, I think, to the need for diversified production from farmers. Because that can certainly help whether when, one area is difficult, as we've seen in terms of cash receipts, other areas may be a little bit stronger. Top 3 concerns, if we want to really break it down for producers in 2024, was really liquidity, farm income levels, and inflationary pressure. And so, this really is not much of a surprise that lenders are concerned about that working capital and having that cash flow necessary. And so, on the crop side, these payments will certainly help address some of those concerns. From producers,
Professor, before you move on, there is
Sure.
a comment in the chat about, and just curious if you've seen this. We're seeing the use of merchant cash advance and other spectrums, but I haven't seen it in any of my farm cases. But have you had any experience with farmers using merchant cash advances? Because as Joe said in the comment, it's the kiss of death for farmers, as for a lot of other businesses, doctors, and other people as well. Have you had any experience with that in the farming industry?
I have not seen that, but certainly I could understand where that would be a significant issue. Um, it- you know, certainly producers do, can rely on some of those 90 days to be able to pay for, for chemicals and other inputs, especially when there's expectation that um, government payments are going to be on their way to cover that. But direct kind of cash advances widespread is not something I've seen a lot of. So producer, I was just going to mention producer concerns and just again going back to some of the Purdue survey throughout the country. uh, you know, do they think that a year from now the farm operation will be better off financially, worse off, or the same? And this is just an interesting perspective, I think. On the left-hand side here, you've got a big drop in November that occurs in terms of those that feel like it's going to be worse off, and a big increase better off. And so that, unsurprisingly, one could correlate very, very much with the presidential election, and even back in um, the previous presidential elections had some similar aspects in terms of who's in power. So there is, I'd say, some optimism from producers, more so on the livestock side, um, but both. And so I know that these government payments certainly at the end of December are not reflected in this optimism. But certainly some expectation there of some good times to come.
So, as we switch gears to agricultural policy, as you kind of alluded to, and as I alluded to in the beginning of the program, there's a lot going on in Washington, D.C. right now, so much that it's hard to keep up with. But are we late in passing the Farm Bill? And then also there was someone that put something in the chat. Is there an anticipation that I guess Trump's philosophy will be a little different on payments, and would those be any payments that are in the pipeline, would they be stopped?
So first, in terms of payments that are in the pipeline, it does not sound like any of the payments that were authorized in December would be stopped, with respect to the economic assistance for row crop producers. Now, there are some questions about some of the previous commitments for adopting certain conservation practices, and how some of that may relate to allocations for green projects and some things that were authorized through the Inflation Reduction Act over from the last administration. That is one that people are looking at closely, because that is a potential where farmers have not only adopted practices, but they have laid out money that they were expecting to then be reimbursed through cost share programs and other conservation programs. So there's certainly hope that money does not stop, since it was already committed, but there's no real guarantee on that one just yet. With respect to the Farm Bill itself, we kind of have to go back to talking about the 2023 Farm Bill, which is what we should be talking about, because right now we're working under the 2018 Farm Bill, and it expires every 5 years. So, it should have been a 2023 Farm Bill, and looking at what that would cost, about $1.5 trillion over a 10-year period. And I feel like, right now we talk about $1 trillion, with a T, as if it's nothing, and really wasn't much before the pandemic that we really started talking about legislation that was $1 trillion. And so this would be the first ever farm bill that would certainly break that mark. And, as a result, we're not talking about the 2023 Farm Bill because there are a lot of questions there. We're not even talking about the 2024 because that couldn't pass either. So both of these were extensions. And the big question is, after 2 years of extensions, are we looking at a 2025 Farm Bill? Current Farm Bill expires September 30th of 2025. As you can see, 80% or so is, in nutrition. There's talk right now about at least the House looking to move forward with some significant budget cuts on the nutrition side, and so that could ultimately affect the ability to pass a farm bill. But if we kind of look at the other components of the farm bill, there's a lot of questions that are there, in particular on those the commodity and the conservation side. From the conservation side, it's a question of the additional spending that the Biden administration authorized and whether or not that additional spending could potentially continue as part of the farm bill. On the commodity side, because of this current need for economic assistance of row crop producers, there's been a lot of questions about the effectiveness of the current commodity programs, to actually respond to price changes and input costs. And so, there, at the very least, an increase in reference prices, which is that point of a measurement that is supposed to reflect some minimum cost of production necessary, and some guarantee, but also just the delay. Right now, from the point that you have price changes to the point that you get payments, there's a year lag, and that's a long time for farms to be able to function and take a hit in terms of cash flow. So, we see right now, I have that bullet point there, the Republican trifecta in DC. That gives some folks some optimism that, legislation could potentially be moved. But at the same time, it does require some of that Democratic support, unless there's alternative means to kind of push forward. And it's not clear that we will see a farm bill that will address all of these issues this year. Some of that also relates to how agricultural labor plays into, farm policy. And, ag labor, these are a couple of graphs and a map here that I have with respect to the H-2A side of things. For those that aren't familiar with H-2A, that is that temporary guest worker program. There's all of the immigration issues and immigration concerns and discussion about migrant workers and, immigration reform has affected the ability for Congress to adopt any type of ag labor reform, for multiple administrations right now, just because it is that constant debate between, how far do we go? In particular, do we allow certain individuals who have been in the U.S. a lot of times working on a farm, but potentially illegal, to start to gain some legal status, if they have been here for a long period of time already doing that. And for agriculture, it is vitally important that those laborers exist. There's a quote that kind of talks about ag, the critical shortage of ag workers. And what it really comes down to is, the physical demanding activities. The fact that U.S. citizens generally will not do that type of work. And as a result, reliance on, foreign workers, reliance on the H-2A program is a big issue, and is a big need. And so, we see here that this adverse effects wage rate that I showed you on this map with all of those increases across the board, that's the 2025 wage rate, but we've actually seen increases in that wage rate. This is set by, the federal government for those H-2A workers is effectively a minimum wage in each of these regions. we've seen that increase between 4.5 and 6.8% every year for the last 5 years. Um, and it's only this year that the average increase, well, some areas are as high as 9%, 9.5% there in the Southeast. We continue to see that significantly increase and result in a lot of cost to farmers that use this. And there are other expenses too with the H-2A program, the regulations involved with it. Farmers need to pay for transportation to the U.S. and then back to their home country. They have to provide housing. It is a significant commitment. You can see that off there to the right, Florida, California, Georgia, Washington, North Carolina. Those are the big states that are using those laborers.
Professor, several years ago when this became an issue and in Georgia, um, there became a shortage of workers for the blueberry farms in South Georgia. And the blueberry farmers came out and said, well, we'll hire locals. And so they went and hired locals. And then they were interviewed on the news saying, hey, they showed up, they worked 3 hours and they didn't come back the next day because the labor is really tough and really intensive. And um, so I think everybody, when we look at this, we probably all have sectors in our areas that are dependent upon the H-2A program. But can you tell us a little bit like what are the most what type of farming sectors are most dependent on the H-2A program?
Yeah, so I mean, blueberries is a great example because it really comes down to your specialty crops, your fruits, your vegetables, your tree nuts. Dairy is one too that will rely on a lot of migrant workers, but and nursery and greenhouse as well.
Mm.
You kind of think about areas where, in particular, there's less of the technology for harvesting that's available, and as a result, that it requires that manual labor. And yeah, certainly picking blueberries in Georgia in the heat of the summer is not something that folks are going to want to do.
Yeah. Well, as we got about 13 or 14 minutes left. So as we move and shift, we hear a lot of talk about tariffs on the nightly news. So what are the implications of the tariff talks that have been taking place over the past few weeks? Obviously, we've been hearing a lot about steel and different countries that are being they're going to have tariffs imposed. But how is it going to impact what we're seeing in the agricultural climate?
Yeah, it's been a wild ride for the last few weeks when we start thinking about agricultural trade because you start hearing about these tariffs and in particular Canada and Mexico came up and with the tariffs that were imposed on Canada, but then actually rolled back and delayed for 30 days. Canada, talked about retaliation. And so, that is the big concern for agricultural producers is the retaliation to agricultural products. And, that was the big issue with the first Trump administration was that agriculture historically has run a trade surplus. And so there have been a lot more exports than imports in agriculture. And so while agriculture was not the target for any of the tariffs in terms of what, the first Trump administration was putting forth for those products coming in, it was an issue in terms of the retaliation. And, so now we're seeing a little bit of a different landscape, though. We are seeing where, we are running a trade deficit in agriculture for really mainly the first time here that's getting pretty significant, where exports have dropped significantly. But, the reality is that producers in markets such as Canada, Mexico, China. I mean, you're talking three major markets for agricultural exports. And those are areas where these tariffs are being talked about. There's a lot of concern about that retaliation, to U.S. producers and U.S. ag, and the challenges that might occur then, for in particular some of these particularly some of these products where, the large portion of the production is exported. Cotton typically about 75%. When we look at food grains, rice and sorghum and others, more than 50% is exported. Um, you know, Significant amount, even on the fruits and tree nuts, fruits and some of the vegetables are being exported up to Canada, um, is a bit of a concern. Oh, you're muted, Nancy.
Thanks. Sorry. We've talked about this, and someone actually put the question in the chat as well. With me being in the Northern District of Georgia, and we have a large poultry business, and we're concerned about the increasing price of eggs, but then also the impact of the avian flu on the whole poultry industry. So can you talk a little bit about that before we move into some of your research?
Yeah, absolutely. I think this slide here probably kind of gives a bit of a snapshot there, and um, in terms of what's happening there on the poultry industry. There's been a loss of over 50 million head of, in particular, laying hens. And it's a simple sort of supply and demand issue in terms of the eggs. We've seen this supply drop. We've seen the price of eggs increase. And the fact that we have lost a significant, in terms of depopulation of flock, um, from avian influenza, on those chickens that are laying those eggs, that is ultimately affected those retail prices that you're seeing in the grocery stores. It's not so much on the broiler side. And so, not the same effect in terms of, the chicken that folks are buying for, from the supermarket. It really seems to be just on the egg side. And, with respect to how that ultimately affects those producers that are, that have those hens, there are good USDA programs that have been able to provide those indemnity payments and do, reimburse for those lost birds. There are some changes that are on the horizon, though, in particular, that producers need to be very, very careful about the biosecurity on their farm, and making sure they're doing things accurate, because we've started to see some producers have multiple outbreaks, and that is a bit more of a concern. And so APHIS is going to start holding back future payments, if they're not actually fulfilling the requirements of the audits, to make sure that things are safe. It's going to take
Yeah.
a little while ultimately to get us back, though, from the current supply situation.
And it's going to be interesting to see. I mean, we're already seeing restaurants increasing prices for eggs and
Right.
things, but thinking about all the products that eggs are in and the increase of the cost of products that just contain eggs for the cost of making. I think it's going to be a big ripple effect before it gets resolved. But we've covered a lot of areas of farm economy, and we're getting ready to wind up our time. But before we do, I really want you to be able to have the opportunity to talk about your research that you've been doing within the Chapter 12 community.
Yeah, I'm gonna give you just a few minutes of a snapshot. I'm gonna run through some slides here real quick. So I've been collaborating with Dr. Will Secor and Paul Guringer at University of Georgia and University of Maryland, respectively. And we've been looking at Chapter 12 cases, and I know this was talked about earlier in the very beginning, just in terms of where we are in terms of, off of the peak in terms of Chapter 12 caseloads. This is straight out of the court's data, but you see that increase now. And so, we take a little deeper look into this, and we've been trying to also figure out a little bit more of what happened here in 2021, 2022, 2023, because that was a very significant drop. And certainly some of the things I showed you with respect to government payments does explain some of that, as well as some of the changes in terms of Farm Service Agency not collecting on some of their loans, and where some lenders have we're pulling back in terms of defaults. But we kind of keep an eye on some of those changes, even regionally. You can see the caseload change, that's occurred. It looks like Southwest. The bolds here are the ones where those are the kind of the driving states within these regional changes. But we're seeing a bit more of an uptick there in the Southeast and the Midwest. Certainly, some numbers that are a little bit more significant compared to the others. But that's just kind of on the surface, what we've been looking at. Some of the things that we have been digging a little deeper into are with respect to actual individual filings and looking at the composition of debt. We focused on 5 states thus far: Alabama, Georgia, Maryland, California, Wisconsin, and looking at trying to figure out how many cases have credit card debt or medical debt. So thinking about that personal side, because there's that aspect of, and again we heard before that more than 50% of that income and the debt has to be farm related and such. And so we've been looking at that interaction between the family and the farm and how that ultimately is affecting these farm bankruptcies. And so while we see a bit of an increase here going from 21 to 22 in terms of cases that have medical debt in these states, we did see general, though, downward trend across both credit cards and medical debt, throughout since 2008. And the upward trend that we saw in terms of the debt was more of USDA debt and even some of that non-USDA, but more ag-related debt. There's some variability across the states as well. So we're trying to kind of distill this a little bit, put it together with some farm financial data, and try to see where that kind of explains a little bit of what makes up the debt composition of these farms that are entering Chapter 12. We've also been looking at some outcome data as well. And so we cut off here at 2017 just because we wanted to make sure that the likelihood of getting an outcome, including a discharge, was there and the plans were completed and through that time. So you can certainly see where, and probably not a surprise, dismissals make up a large part of that. And so one of the things that we're doing is digging a little deeper into those dismissals, trying to distinguish between those that were voluntary dismissals, where there was some type of agreement on that outcome that would be more preferred by the debtor. And even on the discharges there, what ultimately determines that outcome. And we've got some preliminary findings from our econometric models, our economic statistical models that we have. What ultimately increases a more likelihood that you can obtain a discharge in a case. More real property, more monthly income. Joint filers seem to also, be more likely to have a discharge. And from the farm economy, that greater farm income. Dismissals, interestingly, more assets. And so a potential there maybe that things are being sold. And as a result, they're being dismissed. This doesn't distinguish between, like I said, those sort of voluntary dismissals. We found some interesting results right now, probably not surprising to all of you in terms of pro se. Those that do not have legal representation are, more likely to get dismissed. And this is important for us because as part of the land grant institution, one of the things we're doing with all of this research is trying to develop some extension programming and say, hey, we've got some research-based information here that says, get a lawyer, right? Put that effort in right away. And even previous filings, don't think about it as filing multiple times, right? Because you're more likely to just be dismissed if you just keep coming back to the court. One other area too that that actually kind of addresses something that was mentioned in the very, very beginning by the trustee's office was going beyond Chapter 12 with farm bankruptcies. And so we were looking at and saying, we know there are farms, and how do we identify farms in these other chapters? And we decided to look at just farms that have some type of USDA Farm Service Agency obligation, because if they've got some debt to FSA, that means that they have a farm number and they've got to be a farm. And so what we actually find is, looking at this 2008 to 2023, about 57% of the filings with this FSA obligation actually filed under non-Chapter 12. And so that says to us that, in particular, raises these questions. Are all of the focus in terms of Chapter 12 actually sufficiently identifying sort of the farm financial stress? Or do we need to expand the scope of what we're looking at to get a better understanding here? And we heard a little bit of those remarks, I think, right at the very beginning today, about why farmers choose one versus another. And I think it is a question that we've got here too, looking at this, because it's pretty significant there in terms of 7 and 13 in particular.
Professor, did
Yeah.
in looking at the difference in in those years in which the filings dropped off significantly in Chapter 12, some of those years were the time period in which the debt limits were increased in Chapter 13. Have you looked at that correlation of, someone chose a 13 because now they fit into a 13 due to the debt limits, and now that those the increased debt limits have gone away, are those people going to be coming back to Chapter 12?
So that's a great question. And that is, from this sample of cases that we have now, that is actually a next step in this research, is trying to look at deeper into those that are in 13 and say, okay, is this something that could have shifted to 12? Would it have been 12 eligible? Now, but we have seen things like debt to asset ratios that are much higher in Chapter 7 on those cases. Chapter 11 as well, compared to those Chapter 12 filings. 13, well, similar to Chapter 12, just in terms of the average debt to asset ratio of these filers. And then, like I said, we're kind of looking at that likelihood of getting that discharge compared to Chapter 12. Well, for various reasons, 7 is more likely. But we need to dig a little deeper and kind of, why is 11 and 13 less likely to actually achieve that discharge? And it might come down to some of those questions.
There's been a little bit of chat in the chatter in the chat about sub 5, and that the decrease in Chapter 12s happened after the time period of the sub 5 coming on to the scene. And someone was saying, but confirming a Chapter 12 can be easier than a sub 5. But someone else made, which I think is interesting, that said many farmers have too much debt to qualify for a 12, and if there aren't any taxes, then using a Chapter 7 may make sense. But then someone else said that maybe some of the problem is that attorneys feel more comfortable filing cases of a sub 5 or a 13 or a 7 because they're not as well versed, and our bar is so much smaller in Chapter 12 that a lot of people, if they have a client that comes in, they're going to put them in another chapter just because they've never filed a Chapter 12 before. So maybe we can do some education on our local bar and try to get more people filing Chapter 12s. I think it's a good point.
Yeah, that is interesting. And one of the ultimate, like I said, goals of our research is to do more extension outreach education to farmers on what those options are and how to work with, ultimately, your either the legal system or your financial lenders.
Well, with that, I am going to say farewell. Thank you so much. This has been great. I'm going to head to the airport, Brad, so I will turn it over to you. I didn't see any more questions in the chat, but I don't know if you had any. I didn't see any in my email. I don't know if you received any email, but Professor, thank you again so much. It's always wonderful to have you, and great comments, and learned a lot. Thank you.
Thank you. I appreciate the opportunity. Safe travels, Nancy.
Yes, thank you both, and that was very interesting. Would like to see it updated after we get down the road here another hopefully another, well, according to you, 2025, I guess. I hope it's not that long, but I've even wondered if we would see Chapter 12 used as a bridge in the interim while a farm bill is produced. But then on the flip side, we may see just as much ad hoc program payments or support come about to buy time also. So it'd be interesting to see which way things go and how much pressure there is based upon what you've told us and what we're seeing, and that might create a debtor to go, a farmer or rancher or fisherman, to file Chapter 12.
Right. And I mean, to that point on trade tariffs, if there is any retaliation against ag, the expectation is that the Trump administration would look for ways to again, make farmers, whole, or at least try to, bridge that gap, similar to what they did in the first administration with the market facilitation program.
Just like the last time, similar.
Just something similar to last time. I know there's already been some talk about how things might have to be a little bit different, some improvements on that. But certainly the idea that that agriculture is an important sector for the president.
Right. Right. Yeah. I give an example too of just the pressures of these smaller farmers and what they're having to deal with the margins are so small. For an example, I spoke a while back and I gave an example. There's a county out here west of us that where we had back in the 80s, mid 80s, there was probably at least 30 to 40 farm families farming in this county. And now it's down to basically 5 to 7 different families farming the whole county. And so the pressures that are coming for these farmers and to get bigger, and I see that, and I think about what I saw with the debt amounts going up and the amount of land, a lot of land that they're taking on just because of the government payments that are being paid on that, the insurance guarantees, things like that are really boy, I tell you, that's a pretty scary concept when they look at it that way, but I see that sometimes. So I don't think we have any other questions at this point in time. I don't see any more. I'm going to go ahead, and then I think we're done with the hour. I'll go ahead and wrap this up. I appreciate everyone attending today. I hope it was informative. We want to also, again, thank our sponsors, NDC and TFS. Thank you so much for your support. We look forward to doing this, folks. We look forward to any feedback you can give us, anything you'd like to hear. If you feel like that we can spread the word better some other way, let us know. It's what this is about. And so we appreciate everyone attending. And I think that'll do it today. I appreciate everyone, and everyone have a good day and a safe day. Thank you.